Deducting the entire premium of a life insurance policy because a bank required it for a loan means you are walking into an audit trap. Welcome back. This is part 4 of our 10-part series breaking down the most common and costly tax misconceptions surrounding Canadian life insurance. The scenario usually starts like this. You own a business and you need a commercial loan to fund an expansion or keep operations running smoothly. The bank agrees to the financing, but with a non-negotiable condition. To secure their risk, they require you to assign a life insurance policy to them as collateral. From a purely operational standpoint, your logic is sound. The bank forced you to buy the policy to get the loan, so the premium must be a standard 100% tax-deductible business expense. The Canada Revenue Agency does not see it that way. In their eyes, you are paying for an asset, not a borrowing cost. Applying everyday business logic to the rigid structure of Canadian tax law creates a dangerous false sense of security, and writing off that full premium is a direct path to a costly reassessment. The reality is anchored in paragraph 18(1)(b) of the Income Tax Act. This foundational rule explicitly prohibits taxpayers from deducting capital outlays. The CRA views life insurance as a capital asset. When you pay a premium, you are acquiring property, even if that property is sitting in a bank's collateral file. There is one narrow exception, found in paragraph 20(1)(e)(2). It allows a limited deduction, but only if you successfully squeeze your policy through a strict set of statutory filters. The first hurdle is that you cannot use your actual premium paid. You are forced into a lesser of rule, comparing your total premium against a metric called the NCPI. NCPI stands for the net cost of pure insurance. It is a government-prescribed estimate of the policy's raw mortality cost. It strips away all the investment growth and cash value building components of your premium, isolating only the pure cost of the death benefit for that specific year. Because the CRA refuses to subsidize the asset-building portion of your policy with tax deductions, your available deduction pool is immediately slashed down to just that pure risk cost. But the math doesn't stop there. Once you find that lesser number, you hit the second major hurdle, the proration rule. The CRA requires you to calculate a proration ratio. You do this by dividing your average outstanding loan balance for the year by the total death benefit of the policy. Let's look at exactly how this works. Imagine you have a life insurance policy with a $1 million death benefit, and you are paying an annual premium of $10,000. Now, you take that policy and assign it to your bank to secure a $400,000 business loan. Step 1 of the gauntlet. Your insurance company calculates your NCPI for the year at $2,000. The lesser of rule kicks in, tossing out your $10,000 premium and replacing it with the $2,000 NCPI as your new starting point. Step 2. We calculate the proration ratio by dividing your $400,000 loan by your $1 million death benefit, giving us a ratio of 40%. Finally, we multiply your $2,000 NCPI limit by that 40% ratio. Your legal allowable tax deduction is exactly $800. The compounded effect of the NCPI limit and the proration ratio acts as a mathematical grinder. It takes what looked like a massive $10,000 tax write-off and grinds it down to a fraction of its original size. In our example, the business owner expected to deduct $10,000. The law allows $800. That is a massive $9,200 discrepancy hiding in a single tax year. Now, imagine claiming that incorrect deduction year after year. Overstating an expense by over $9,000 annually builds a glaring red flag in your corporate filings, making a CRA reassessment almost inevitable. And there is one final caveat to this entire process. It involves the tracing rules found under paragraph 21(c) of the Tax Act. Even that meager $800 deduction is completely disallowed if the bank loan wasn't used for an eligible purpose. The borrowed funds must be strictly traced to earning business or investment income. To protect yourself, you need to take action every single year. Contact your life insurance carrier at tax time and request your exact, verified NCPI calculation. Do not try to estimate it yourself. Then provide that official NCPI document, along with your average outstanding loan balance for the year, directly to your accountant. Surviving a CRA audit requires relying on strict formulas and verified data, never assumptions. If you found this breakdown helpful, please like, subscribe, and tune in for the 5th video in our series as we continue to untangle Canadian tax law.